Thank you for joining us. So, Boris Johnson has finally got backing for his Brexit deal last night from MPs, but they've diminished hopes for an October the 31st exit. What does this mean for businesses, and what are the impacts that this has had already?
Well, it's not surprising what happened. We have been arguing for this for a long time now, that we should have an extension and then a deal. So by having the deal voted, I think it's a good news, because we now have a consensus in the parliament on what can Brexit look like. Now the timeline was very short, so this is why we were expecting this technical extension to take place. So now that we know that it will be more or less approved by the Europeans in the current, I think, week, by January 31st, we will know more about the next steps. So for me, clearly, it takes out a bit of the uncertainty that we have been through the whole year. So it's a good news for businesses. Now, I think what is more important than the Brexit deal is what comes next in terms of political changes. And now the odds are very high for early elections. Maybe with the referendum, this is still not very clear, but clearly this can be another step of uncertainty, which is not directly linked to Brexit, but still it will mean an uncertainty. Who will win? What type of policies they will pursue? Would it be something more in terms of fiscal stimulus? Would it be more corporate friendly? So we will still have this step by year end. Now, for me, what is more important for businesses is for sure that no deal uncertainty is now lifted off. So we can consider it as a tail risk. But what happens with all the stocks that have been accumulated over the island over the whole year? Because now we have stocks that are at the highest level since 2009. And in front of that, we don't have demand. We don't have domestic demand. We don't have external demand, because the Eurozone is barely growing and the whole world is slowing down, and we don't expect it to change in 2020. So it's a bit the problem that the UK companies are facing now, whereas they need to get rid of these stocks, and it might mean that they need to discount the prices for some of them. So in economic terms, I think this could mean that we could see a technical recession at the turn of the year, so 2 quarters of negative growth, because it will take time to absorb all this preparation work that have been done by companies, but also by households. Actually, households have front-loaded their spending, not on big ticket items, but on different type of goods that they thought they could be not on the market anymore if there will be a hard Brexit on October 31st. So clearly it means that they will spend less in the coming months. So we are going to enter into an adjustment period because of these preparations to this high uncertainty related to Brexit.
Great, thank you. So we're still not likely to see calming down of trade tensions or economic certainty anytime soon, both from a UK, EU perspective, but also globally. What can businesses do to mitigate some of these risks?
Yeah, clearly the uncertainty is at a record high and should remain so by the US elections. So on one side, we have the UK with its own situation. On the Brexit, we know that, okay, we will start a transition period and we will start technical negotiations to see how we can implement this custom checks that have been negotiated on the IRC. So it's not still very sure that they can be implemented. So for this, 21 months at least will be needed. So I don't foresee a clear exit until 2022, maybe end of 2021. But again, we need to see if it's really feasible. So in that moment in time, probably the exit that will be a free trade agreement with probably zero tariffs. So this is what they look for. So a sort of CETA++, if you want, between the European Union and Canada. But still, it changes the framework. Okay, there will be no tariffs, this is a good news, but there will be custom checks. So we can't get back to what we had, because clearly the time at the border, if the infrastructure would not be optimal from the beginning, which is very likely, would take time. And this would reduce the flows of goods that are transported between continental Europe and the UK. And I think it also reduces the opportunity in terms of investment, foreign investment that until today was very important for the UK economy. And we have seen that it reduced 3 times since the Brexit referendum. Now, if we go out of the UK and if we look at the US, for example, we clearly see that there are some signs that they want to have a deal with China, but we don't necessarily think it will be more than a mini deal, because China is not likely to give up on its own demands to the US, and especially because they know that there will be an US election, they know that there is the impeachment procedure. So let's say that the President Trump administration is a bit more weak now than it was 6 months ago. So we would remain in this high uncertainty environment until the elections. And I think that now it's time for the Trump administration to turn to Europe. So this would be a new step that I'm not sure everybody has in mind. And we have a deadline that is on the 17th of November, where the Trump administration will announce if they want to implement 25% tariffs on the car imports. They could go with 10 at the beginning, because this is a bit their negotiating approach. But still, we mean there will be a change in the environment. And now, when we know that the German economy is very close to recession, that could mean that they will be even more in a weaker situation. So globally, it means that we are in an environment of very low growth amid very high uncertainty that will continue to stay, which means that non-payment risk is very high. So when we look at global insolvencies, for example, when we look at regional numbers, every region registers growth this year and next year. So globally, we expect plus 8% next year, which is actually the fourth consecutive year of increase. So it means that demand for protection from companies would increase, because they would continue to do trade with other countries or domestically. But amid this higher non-payment risk, they would want to be protected. And clearly, when we look at the regions, Asia would be at plus 16%, Europe would be at plus 4%, the US and North America would be in a reversal of trend. So we were seeing business insolvencies falling, and now they are picking up, so plus 3%. So again, it's a question of more frequency and also about severity. So it means that when we look at companies that are getting bankrupt, there are also signs that there are higher and higher companies that are getting bankrupt. So major insolvencies, so companies that are not SMEs, that have a turnover above 50 million euro, are more numerous, and the size of the turnover that went bankrupt over the past months has increased. So it means that on the supply chain, we have much more impact. We have other suppliers, other companies, maybe small ones with very weak working capitals that would, and cash flow, that would default because of this contagion. So it's something that clearly needs to be watched out. And in terms of sectors, we have usual suspects like the retail sector, but also construction, metals, so sectors that are in this situation where they have higher frequency, so more number of companies that are getting bankrupt, but also higher severity. So the size of the turnover and the size of these companies that are bankrupt are higher. Yeah. So clearly, I think for me, we will remain in this environment where companies would need to protect. Global trade is contracting, that's a fact, and it's contracting since H1, and it will continue to do so, because we see that the flows of goods that are transported between China and the US are contracting very fast. Europe is not really a substitute. It is to some extent, but it can't compensate everything. So globally, we have a contraction in goods. So in volume terms, we have less goods that are transported, and also in value terms, they are sometimes cheaper. So it means that we lose on both fronts, volume and value, and we need to continue to size opportunities in terms of exports, but also to be protected in case our clients can't pay us.
Mm. Has it changed appetite from an insurance perspective?
No, not necessarily. We continue with our main core business, which is to protect companies from this risk and to actually give them the opportunity to go and export when sometimes don't have the expertise on their clients or on the market where they go. So we continue to advise them to do so. Now, obviously, in this kind of very high uncertain environment, everybody is selective. So we can't advise a client to go to another client that would be risky from our point of view, because we have such a big variety of tools that allow us to actually understand what will be next, what will happen in 6 to 12 months.